dear friend, the coordinator of the session, CA Sujay Sharma, the coordinator of the series, CA Chandan Lahoti, and dear friends, good evening, all of you. This is the series of Tuesday where we have taken up steps to do series of program on accounting auditing. Before we start up with the topic, I request Mishra ji to play ICM Motor song.
य एष सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रदब्रह्मा तदब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Good evening, everyone. With the objective to create awareness on auditing and INDs, the committee of WSF ICI has started a series where we organize every Tuesday a session on accounting auditing. Friends, we all are aware that today's era where we need to give specific focus on the accounting and auditing. Signing is not a right, it is more responsibility. Before we sign, we have to have due care and professional skepticism and compliance with all the rules and regulations. So to have a seriousness of this thing, we have started virtually, specifically with the objective to cater to the need of every member in region. We have always option to have a physical program at WRC BKC office or at certain offices in the WRC. But we wanted to reach to the every member. Every CA in the region should have equal opportunity to learn. For that purpose only, this is done virtually. So my humble request to each one of you, please spread this series awareness to all your colleagues and members. And we are trying to add more and more topics and base-to-base faculty from this industry. If you have any suggestions, please feel free to be in touch with me or anyone from our committee. I will be more than happy to add the topic and the faculties of the requirement. Today's topic, when you just look at it, is on common errors. It is well said that it's always better to learn from others' mistake. So when it's a common errors, we should not do mistake, and this is an opportunity for all of us to learn from others' mistakes. That's why that we are not making mistake by ourselves. The faculty is very well known, has a very good experience on this particular industry for so many years, and he is the right person who can deal with providing us insights of common errors. When you just look at common errors, it also gives opportunity that how can we learn from that? How can we ensure that practice in our firm is being improved so that this kind of mistake shouldn't happen? It is covering common errors on CARO and auditors both, and I'm sure that with this experience and the kind of topic, we all can learn a lot of things here. At least couple of things if you are able to take from here and implement in your office. We will believe at WSC that the purpose of this series and efforts have been justified. With this objective, I request the code of session C. Sujesh Sharma to introduce the faculty.
This is my privilege to introduce our today's speaker, Mr. Shreyans Ravrani, a fellow chartered accountant. He is a partner in assurance practice of SRBC and Company LLP, which is a member of the Ernst & Young Global. He is a post-qualified experience more than 18 years. He is specialized in assurance services covering financial statements, auditing, reporting requirements under the Indian GAAPs and IFRS. His experience including auditing various listed entities spread across the India. He has led statutory audits from the manufacturing sectors like power sector, refining, capital intensive machineries, pharmaceutical sectors. He has also experience in managing group reporting of the IFRS financial statements of MNCs based in India. He has taken various training at ICI and ICSI on the topics covering related party transactions, accounting, auditing standards. He has specialized in INDES transactions and has been faculty in the INDES certification courses by the ICI over the last few years. He was contributed to the publications of education's material of INDES. He is a certified data analytics experts, IFRS accredited professionals in the firm from the last few years. He is a trainer of the data analytics tools and implementing the new tools in the practice. Apart from the accounts and finance, he has also completed Accelerated General Management Program from Indian Institute of Management, IIM, Ahmedabad, and Aluminium IMMA. I would like to ask Shreyans to take the board.
Thank you, everyone. Thanks for the introduction. Hope I'm audible and visible.
Yes.
Yes.
The only thing is that I'm not able to share my screen. It is showing that the participants has disabled it.
सर ऑन किया है
On कर दिया? Okay, just give me a minute. Is the screen visible in PPT mode?
Visible shapes.
Okay, slide moving.
Are visible.
Perfect.
Yes.
So good evening, everybody, and thank you, everyone, including Chintan Bhai, Chandan, and for giving me an opportunity to share the knowledge on this subject. I agree with Chintan Bhai that see in today's world, the way of learning things is that you learn more by others' mistake rather than your own mistake. But given that today's topic is my expectation, and obviously the expectation of regulators are we should not make any mistake, at least in the auditor's report. See, irrespective of the size of the company, financial statement, complexity, auditor's report is the only one deliverable which is our responsibility as a chartered accountant and as a statutory auditor of the company. Though it is very limited in the number of the pages, correct, but it is a very high value in terms of its relevance in the market, to the investors, to the stakeholders, and everybody. Chintan Bhai and Chandan, I'll just narrate one incident. I was discussing with one of my one of my consultant. Correct, he is a consultant of internal process. Correct. So he was telling me that for one particular large listed company, he said, see, I have done their process narratives and I've done this and I've done this and I've made a 250 pages SOP for that company. And then this is how I am recognized in that company. And I got an, they value me and they are my one of my biggest client. I said, I completely agree, sir. You need to print 250 pages to get that recognition. In this entire annual report of 200 pages, we have only 8 pages, which gives us a higher recognition, which is our auditor's report and our signature on the dotted line. So that is the importance we carry as a statutory auditor of any company. Our signature, our audit report has a very prime importance and is seen with a very utmost importance, not only by the regulators, but also by the market as such. So never ever take this entire audit report as a very, I would say, lightly. I've seen people making few errors in the auditor's report, and most of them are not because of the lack of awareness, but most of them are because of the lack of, I would say, sincerity. It's like, what if we make a mistake? But it is, to me, on a very practical note, I'd like, your auditor's report is like your CV. Correct. With every new auditor's report, you are making one CV in the market. See, this is what I have done. This is your credential. So my humble request to all the participants in these meetings, and I see more than 80 people right now in meeting, to get acquainted with the entire nitty-gritty of the auditor's report. Wherever you have a question, raise your hand and we will allow the participants to speak up once a particular topic is covered, and try to bring out any practical cases, practical challenges which you have seen in your real life as well. But the most important part, and for the auditor's report, is that certainly we cannot make mistakes. And last thing is that always refer the institute publications. This is one of the area where institute has given the highest number of publications. For IND-AS, you will have only limited education material for a particular IND-AS, and even that is not applicable or not available for all the IND-AS as such, or for all the accounting standard as such. But for auditors report, we have a lot of auditing standards, which is SA 700, 705, 706. Then we have ample number of standard disclosures in the auditors report, standard qualifications. With every new requirement which is coming for the auditors, institute comes out with a guidance note at a right time, right? Guidance note for audit trail, guidance note for reporting on the transactions of the funding, guidance note on CARO, guidance note on ICFR. So with the set of so many guidance note available in the market, we would really, it shows the importance which is given by institute to the auditor's report. So I think today's agenda, what we will do, we'll try to cover what is auditor's report, just a basic thing. We all know what is auditor's report, but just as a refresher. Then we will cover entire section into two parts. There are few reporting requirements in the main auditor's report, and there are few reporting requirements in the CARO as well. Both of them, we will cover each and everything clause by clause, and we'll see how far. And I'll try to give you more and more practical examples, more and more practical scenarios which I have seen in my life, where I have seen some challenges, and we have taken a reference of auditor's report, which is issued by FRRB, comments on auditor's report by QRB, all those comments which has been available in the public domain, but also whatever is being learned from my peer people, that I'll try to share. So I think the content looks to be a little bit larger, but the idea is mainly that coming back to the auditor's report. What is the auditor's report? Auditor's report, see, as an auditor, we are supposed to report on whether the financial statements are true and fair or not. In case of LODR or quarterly results, whether we need to give negative assurance, whether there is any error or omission or any misstatement which we have noticed as a part of our review of the financial statement. So basically, it is little lower than certification and little higher than the negative assurance. In certification, we give a true and correct view, whereas in case of auditor's report, we give true and fair view. And just to re-emphasize what is true and fair view, in every account balance, it is stated that if the auditor has taken comfort to the 95% of the population, then it is fit to give a true and fair view. If you have taken comfort, if you have not performed audit procedures on the 95% of the population of that account balance, then certainly that is not the right mechanism to issue a true and fair view. So this is how I see as an auditor's report. The second problem or challenge with the auditor's report is that over last 5 years, there are a lot of corporate complexities which are increasing across the world. There are new set of transactions which are being designed by the management, correct? And with this new design set of transactions, there are new innovative way of accounting and new innovative way of doing fraud or manipulations by the management. Earlier, before 20 years, nobody would have emphasized that a transaction, that a preference shares can be treated as a debt or equity in terms of the Ind AS. Though it is being stated as an equity share capital, but it is being classified as a debt. There are a few transactions. I would say the design of the transaction is such that what appears on the face of the transaction is not the real sense of the transaction. And therefore, Government of India, MCA, has started enhancing the responsibility of the auditors. Earlier, before 15 years and before CARO ages, there was a CARO, manufacturing and any other company's auditors report. Before there was nothing. It was only 2-page auditors report. Like in case of any partnership firm or LLP today, the auditors report is only limited to 2 pages. Whether the financial statement comprising of the balance sheet, profit and loss account, cash flow statement are reflecting true and fair view or not. But now, the auditors report, the reporting requirement under Rule 11G, the reporting requirement under the regulatory and reporting matters are increased significantly, and that is where the problem starts. That there is so many reporting requirement in today's world that it is becoming an onerous for the auditors at time to address everything in the given set of time frame available. And trust me, with so many digitization and automation happening, management and the clients are expecting to close their results as soon as possible, because there is this kind of rat race among the listed clients to report or publish their results as soon as possible. Somebody wants to publish within 15 days, somebody wants to publish within 30 days, somebody want to publish within 45 days. Nobody wants to go up to the 60 days till the last minute. With this pressure in terms of the timelines, and with the complexity of the transaction and the business and the increasing, and the third piece is the enhanced reporting requirement. The role and the responsibility and the auditors have increased many times. And again, I re-emphasize, you have less amount of time, you have complex businesses to deal with or complex business model of the client, and third thing is the higher responsibility. So in all these three cases, how do you deal with this entire set of new reporting requirements? How do you make sure that you don't make any mistakes? Is a very important case or is a very important learning for all of us to do. Now, let us go, before I go to the auditor's report, there is new thing which is called CARO. Now, CARO is a very unique set of auditors report which is relevant in India only, to the best of my knowledge. No other country or no other developed country has such kind of reporting requirement that every company to whom an audit is applicable, their auditors should apply or report under the CARO, barring few very minuscule companies where the CARO might not be applicable. So what is the importance of the CARO? If you read the CARO completely, CARO is all about not only auditors report, but they are trying to comment or trying to obtain the views of the auditors on many aspects of the business, may it be financial, may it be what is the strength of the business, may it be what is the strength of their internal controls, what is the strength of their regulatory compliances, what is the strength of their business relationship, banking relationship. All of this comes into the picture in the CARO, and then that's why the CARO is a very humongous responsibility. I would admit that, and that's why it is very, very important for us to make sure that we don't make any misses in the CARO. The challenge with us as an auditor, and which every individual, every responsible individual in the world, is that nobody recognizes that you have done 99 good things. The moment you make one mistake, you are going for a toss. And that's where the trap is, that out of 21 reporting clauses of the CARO, if the auditor has not responded correctly, accurately to any one of these clauses, then it doesn't matter what we did for the balance 20 clauses or what we did for the main audit report. One mistake is good enough to make the life of the auditors very tricky, especially, and now we have new regulator called NAFRA. NAFRA is going through files and audit files in details for select cases, and any incorrect reportings, any incorrect judgment being taken, they are all being scrutinized in detail. So it is equally important for all of us to understand that whatever judgments we make while doing the auditor's report, is being applied very well in the with due respect. Now the question comes is that, do an auditor's report is a judgment? To me, it looks to be a judgment because it doesn't restrict our reporting to the transactions which has happened in the past, but is also enhances our responsibility to the future of the company. Like in CARO, there is one reporting requirement. What is the going concern evaluation of the company? So actually, you're making a judgment or expressing a view on the going concern of the company, which was earlier, no doubt, part of the auditing standard. And you need to highlight or you need to address it if there is certain indicators which doubt the continuity is a going concern or there is a material uncertainty. But now, under CARO 2020, the reporting requirement is stringent, and we as auditor has to make an expressive comment whether the company has a going concern or not. I would thanks to ICAI for their efforts making that reporting very, I think very in terms of the with full of the caveats that on the basis of the representation of the management, board of directors, plan of the company, blah blah blah, everything, the company auditors report that the going concern evaluation is appropriate or not. But still, with five or seven different information or evidences lying in front of you, you are still obliged or you are still being forced to make a comment about the going concern of the company. So effectively, by looking at the CARO, I think a lot of my multinational clients says that what is the importance of the CARO? I said, if you read the CARO of your company, it is as good as an internal audit report, but it talks about everything about the company, not only one aspect of the company, but a lot of other aspects. So we'll try to go through and that how do we understand the auditor's report? That is the most important part. The auditor's report runs into almost 12 to 13 pages if I make it properly, correct? So is each and everything being important? Yes, I would say each and everything is important in the audit report. But what is more important that we will try to emphasize now. I have just segregated the entire CARO into two parts, entire reporting. One is a factual reporting. Factual reporting means it is completely based on the facts. Like there are various kind of factual reportings. Whether the company has incurred the cash losses or not, it is very much visible or very much apparable in the financial statements of the company. Whether the CSR specific initiatives has been done or not, whether the money has been transferred to any account or not, all of these are the factual reporting where you don't need to apply your mind. You just need to pick the right evidence, right details and report it. Whether the company is doing inventory counts or not, whether the physical verification of the PPE has been appropriate or not. The problem or the challenge or the complexity starts in case of a judgmental reporting. Judgmental reporting, one is I talked to you about going concern. Assessing whether there is a substantial doubt about the company's ability to continue as a going concern or not. Correct. Internal audit. This is very tricky. That now the auditors are expected to comment on the adequacy of the internal audit works. Now, you imagine that then how do you deal with this aspect of the subject? That how do I comment as a statutory auditor whether internal audit is appropriate or not? I know many clients, many companies doesn't allow statutory auditors to be presented when the internal audit reports are being discussed by audit committee members. But after this clause, this has been more mandated, and now we are going to the clients and telling that at least provide us what is the scope of the internal audit, what is the frequency of the internal audit, what are the areas of the internal audit, because it's not only we are not just asking for the sake of our knowledge, but we are officially obliged to make a reporting on the adequacy of the internal audits. Third thing is the frequency of the physical verification. Now, what I said above is that whether the inventory counts are being done appropriately or not, that is fine. But whether the frequency of the inventory count is appropriate or not, whether the frequency of the PPE is appropriate or not in terms of the size and the nature and the complexity of the business, that is where your judgments comes into the picture. And that is where the most complex parts start. Because every company will have its own processes, which will have its own frequency, will have its own way of dealing the things. But now you as auditor has to ensure that whatever processes they are following, they are not completely outlier. Outlier in the sense, it might be possible that a company is doing inventory physical verification once in a year, a company which is doing 10 times in a year, company which is doing 3 times in a year. All three are right, depending on the nature of the goods and the kind of movement of the materials which takes place in their industry. Now, in case of physical verification of the fixed assets, it is also equally important that some companies does once in a 3 years, some company does once in a 4 years, some company does once every year. So what is the right frequency for an PPE physical verification? That also has to be kept in mind. So our responsibility is not, even though the frequency of the physical verification, inventory counts, everything we consider as a part of our routine internal audit procedures, but we don't make an expressive statement in the auditor's report. But now we are supposed to make an expressive statement in the auditor's report that yes, what is the frequency of the internal audit report, and so on and so forth. If you have any questions, meantime, just raise your hands, or just, I don't know what is the mechanism under this Zoom call, because it is, as Chintan Bhai rightly said, that the idea is to connect to large set of people, and that's why the virtual classes are being organized, and it's going to be a big success. But I have a little bit of kind of challenge that I am talking to a black box. So unless and until you guys respond me, it's very difficult for me to realize that yes, I'm speaking to people and people are listening to me. So you have to bring me some set of kind of response from anybody of you as and when you have any questions or any doubts. So which will make me realize that yes, the audience is there. So now, before I go into the CARO and the main report, I have divided, also further divided. So coming back to the previous slide, just one more part. Coming back to the previous slide, the one more part is that in case of judgment and reporting, you need to be very, very alert, and your audit procedure should be more robust as compared to the factual reporting. Factual reporting are very easy to access and easy to report. But in case of judgments, how are you applying those judgments? What kind of factors you have taken? Whether the appropriateness of the internal auditor, internal audit scope, whether the frequency of physical verification is right or wrong, that all depends on the nature and the circumstances of the case. So be mindful of those cases where judgments are applied, and I would say, and for factual cases, make sure that it doesn't contradict with what is there in the financial statements. Second part of the CARO reporting, see, if you read the entire CARO is completely divided into 3-4 parts. First of all, they are asking for a regulatory compliance. Regulatory compliance means whether the section 177, 188 has been complied or not. If it is a Nidhi company, whether the provisions of the NBFC are complied or not. If they have done the fundraising, whether the provisions of the Companies Act are complied or not. Now, there are few things about the corporate governance. Corporate governance measures, whether there is any fraud or not, whether there is any whistleblower complaints or not. So, I think the scope is not limited to the financial reporting. The scope is much more enhanced to not only related to the processes and the control, like whether a process and control, whether the company has adequate internal audit system or not, whether the physical verification of the inventories and PP are giving any significant exceptions or not. Then they, and the challenge is that I would like to re-emphasize that we as a chartered accountant interpret things in the way at times which suits us. Earlier, it was that the physical verification of the inventories is appropriate or not, and whether significant material observations were made or not. Now, nobody defined material, and hence people started applying that either 15% can be material, 5% can also be material. And somebody who doesn't want to report, they said 15% is not material. Somebody who wants to report 5%, they reported 5% material. So then MCA came out with a classic threshold of 10% on each class of the inventory. So this is, so it shows that unless and until we are aligned and we are not, or we are implementing the rule of law in a true spirit, if we don't understand the spirit of the regulators, in what context they are expecting us to respond, in what context they are expecting us to respond, then in that case, the challenge for the auditors will increase significantly, because we are giving enough opportunities for the regulators to demonstrate that we don't understand the spirit of what you want, and then you make more stringent, more precise rules, which becomes at times an onerous for us. Right now, I'll tell you how it becomes onerous for us. Earlier, we were saying that the discrepancies on the physical verification of the inventories is not material. Fair enough. Now we have to calculate that whether it is 10% or not. So we apply on each class of the inventory, what was the level of inventory, what was the shortage or excess has been came out of those physical verification, whether those shortage and excess are beyond 10% or not. And then lastly, whether we should see on a net basis or a gross basis or not. So all those classifications, all those nitty-gritty starts coming into the picture. And hence, we should be very, very careful to understand what is the spirit of this law and how are we planning to apply to stop or restrict any further new reporting requirements. The fourth one is the financial operations. Financial operations means whether the company will continue as a going concern or not, whether the company has what I would say, the cash losses or not. So CARO is like a very, I would say it is a more of an extended internal audit report of the company with a very specific set of the questions being asked by regulators and being asked by one set of people, which is called statutory auditors. So try to think over that. Yes, if you are ensuring regulatory compliance, and why did I did this bucketing? If you are ensuring regulatory compliance, if you have to report whether section 177 and 188 has been applied or not, make sure that you have discussed the same matter with the corresponding part in the companies, which is your company secretary, to ensure that their understanding and their reporting is not contradictory to our reporting. In terms of process and controls, we should understand that those should not be contradicting to what is reported by the internal auditor of the company. Financial operations, something completely should not be limited, should not be completely misaligned or not aligned to the financial statement of the company. Any questions? I think there are a couple of questions. Q&A, I'll take it from there. Okay. Now coming to the core subject of the auditor's report. So what is the auditor's report? Or what are the key contents of the auditor's report? Title, most important part. Still there are QRB and FRRB comments that at times the title is also not right. So at times we have to address so we really need to be clear that when it should be addressed to the members and when it should be addressed to the shareholders. Annual, I would say the listed company LODR reports are always addressed to the board of directors of the company. So basically those are addressed to those charged with governance of the company. Now in case of a year-end audit report, since your appointment is done by the shareholders, so it should be addressed to the shareholder company. Okay, so that talks about the addressee. The second part is the opinion paragraph. What is your opinion? Whether it is, so earlier what you used to do, the auditor's report was before 3-4 years, I'm talking about auditor's report, management responsibility, and then there was one paragraph of the opinion somewhere in between. Then regulators or stakeholders said that we are unable to understand quickly. So opinion part is on the face and the front part of the balance sheet or the auditor's report, that this is the opinion of the company. What is the other information which is associated? Responsibility of the management. So if then since we are issuing a report, and most important part I missed to state that auditor's report is a legal document. Okay, don't take it lightly. Something which you have written, signed with a unique number, which is UDIN, you are very well obliged and responsible for each and every word of that report. And you cannot say that it was an inadvertent error or something like this. So please be sure that yes, what you are writing. And hence, Institute came out with a very good idea that when I'm issuing a legal document in terms of the opinion on the financial statement, I will narrate that my opinion on the financial statement is based on certain certain responsibilities of the management. So what are those responsibilities of management? It says very clearly the preparation of the financial statement is responsibility of the management. Our responsibility is to audit those financial statements. Then it talks about what is audit. Audit is not to verify everything 100%. We perform our audit on a test check basis or on a sample selection basis, which is very clearly written in this auditor's report. Third thing, the new concept was start called key audit matters. The genesis of this requirement before 3 to 4 years is that regulators across the world started that sees every listed company will have certain kind of complexity judgments in the audit of the financial statement. there'll be few judgments which have been taken by the management. So what are those judgments which is being taken by the management, and how the auditors is dealt with those judgments, and hence this is called as key audit matter. Mind you, key audit matter is not a qualification, is not a MOE, is not a modification of report. It is just highlighting key, what were the key audit matters during the entire audit and how did you deal with those matters. Other matters is something very, very important. There is a confusion between other matters and emphasis of matter. Emphasis of matter, where you want an emphasis of a certain event or a transaction in the financial statement of the company. So certainly emphasis of the matter will always be related to a transaction of the company. And other matter will be something which is not related to the financial statement of the company. Mind you, the other matter will not be related to financial statement of the company. Like what we write in the other matter is how many of the subsidiaries are audited by another auditor. In case of bank, how many branches are audited by another branch auditors, or who were the branch auditors. So it has nothing to do with the financial statement of the company. It is more with respect to your or our responsibility as an auditor and how much reliance we have done on those auditor report. At times, the previous year financial statements are audited by another firm of chartered accountant when you are on the first year of the auditor. So we write in the other matter that yes, the previous year financial statement are audited by another firm of chartered accountant. So mind you, the difference between other matter and the emphasis of matter is certainly something relating to the financial statement of the company, and which is very, very important. And you want emphasis, or you want to draw the attention of the shareholders on that emphasis. Correct. Whereas in case of financial statement, whereas in case of other matter, it is more about the I would say other matter is more about the areas where you as an auditor have relied on somebody, or you want to highlight something as a part of your audit. It has nothing to do with the financial statement of the company. Legal and regulatory matter, under Companies Act, there are various reporting requirements which has come as a legal and regulatory matter. So what are those legal and regulatory matter that we need to report in this? And finally, the place and date of the signature, very, very important. Questions, because since I'm in PPT mode, I'm not able to see the questions. Chandan, can you see the questions, or should we take it later? Okay, let me just. Okay, there are two questions. How to decide which one is factual reporting and which one is judgmental reporting? Okay, the second one is very, very nice question. In case of console, what is adverse effect or not? Fair enough. I think I will answer both the questions once the both the clauses comes into my clauses. So screen visible in PPT mode again? Can participants just raise their hand to give me confirmation that the screen is visible? Okay, let me do one thing, just a second. So now coming to the, so I have just drawn this one slide that where do you find the sources of all this information? Sources of all this information means where do you get the standard language? Where do you get the MOE or EOM? Where do you get other matters paragraph? So standard language of the auditor's report is given in SA 500 and SA 700 or 701, 705, 706 and 7020. Okay. Modifications and the EOM drafting qualifications, basis of qualifications, etc. has been given in SA 705 and 706. Other matters, again, all of them above. Just a second, I'm logging in from other device so that I can see the Q&A as well. Okay, I think it's not working. So first of all, let me come to the first and basic important part is the, just let me do one thing. Okay, I think now it is perfectly working. So now these are the standard on the auditing on which the entire overall reference to the auditor's report, modifications, and the EOMs and everything are being covered. Any questions till now? Now, the key and the first and foremost important part is what is the difference between, I think my only PPT version is visible, correct? Sorry to ask this question again and again, but since I've made some different setting, so if just anybody can confirm on the chat box that the MOE and the qualification slide number 8 is visible. Hello?
Yeah, it is visible.
It is visible, no? Perfect. Sorry. Okay, great. So what is MOE? The difference between a qualification and a MOE. MOE is matter of emphasis or emphasis. We call it EOM, we call it MOE, whatever it is. This is the one of the most common error which is noted in any of the financial statement. First of all, MOE is not a qualification. That means we don't write subject to in the financial statement. It is just an attention which you want to draw it to the users of the financial statement. There are 4 areas on which you want to emphasize or which you can use MOE. One is the uncertainty relating to a future outcome or exception litigations. Second one is a significant report or event between the financial statement and the date of the auditor's report. Mind you that that event has to be a non-adjusting event. Okay. Early application of a new accounting standard which has been done. And the fourth one is any major catastrophe or which has continued to affect or significant of the financial statement. Last one, I can give a very relevant example that where in case of COVID, the businesses were impacted for so many years. Correct. And hence, there were a lot of companies which has given an MOE because outcome of the COVID and its impact on the financial on the operations of the company and consequent impact on the financial statement was completely unvisible or unrealizable. That was one part. A significant uncertainty of the future outcome of the litigation or regulatory action means if you are into very high regulation which can have a significant impact on the financial statement, then certainly you should give MOE, or any regulatory action means any kind of investigation which is going on, or there is any new accounting standard which you have applied, an early application. Okay, the fourth one is the any subsequent event that occurs between the financial statement. So these are the 4 things which has to be stated or which can be considered for MOE. Other than this, there is only one area on which EOM or MOE can be given, which is if there is a different accounting treatment between the law and between the IND AS, like, and this situation is no more relevant, like a scheme of amalgamation or merger as a different accounting treatment than what is given in the IND AS. Then it comes as an MOE. Now the possibility has been completely negated, because whenever a scheme is filed with any company, the same is being, I would say, the same is being subject to auditor's certificate on account of appropriateness of the accounting treatment under the IND AS and enhance. So it is always the auditor's duty to make sure that the accounting which is prescribed in the scheme is correct as per the accounting standard, and hence the possibility of a different accounting treatment as per the scheme and as per the IND AS does not arise. Secondly, just try to figure it out, what are the different kind of qualifications. So one is what we talk about, EOM. Second, there are qualified opinion, adverse opinion, and disclaimer of opinion. What is qualified opinion? That you are, as an auditor, you don't agree with one or two things in any auditor's report, but you still continue to state that the true and fair view of the financial statement is appropriate. Okay, that is qualified opinion. Adverse opinion is more with respect to that you agree that the company is not at all doing well, and it is a strong disapprobation of the agreement. Disclaimer is that you don't have anything to report, means you are unable to make any comment, and that is why it is called disclaimer of report. Disclaimer of report and adverse opinion are very rare in most of the times. Most of the cases we see qualified opinion, and the common error which are being noticed by the regulators is difference between qualified opinion and EOM. I have seen few EOMs like the confirmation of the receivables and payables are still in progress and management has considered this as an advances. Now that cannot be an EOM. Either you conclude that you are satisfied with that, or either you don't conclude you are not satisfied with that. This cannot be an EOM. An EOM can only be of four things. Regulatory action means there is some sort of uncertainty which is involved. In case of exceptional or litigation cases, any subsequent event which has occurred, new accounting standard which has any catastrophe. These are the four cases where you have to give a kind of EOM. Otherwise, no other cases can be EOM. Now we're coming to the errors in the financial statement. First of all, the biggest and the most common error is the alignment with the financial statement. Like the financial statement in case of listed company will say has paid a managerial remuneration of so and so rupees. But in case of 11G audit report, we will say that no. There was no managerial remuneration which has been paid. Accounting standard definition under the financial statement is different, and accounting standard definition under the audit report is completely different. Account level reportings means somebody will say, okay, fine, this was not there was no inventory or PPE in the financial statement, but if you see the financial statement, there is an improvement in the PPE. Second part is the reporting does based on the management representation only. At times, FRRB and QRB has noticed that the reporting is done purely on management representation. So it is always our duty to write to the best of our information and explanation given to us. So you have to have obtain some information, some explanation for the purpose of that, and then basis that the entire reporting has to be done. Third and the most important part, which is not visible in many financial statements, is any qualification or modification in the auditor's report. See, when you are qualifying, why will you qualify? You have a disagreement. So there has to be a disclosure, corresponding disclosure in the financial statement. Like, for example, I will give a classic case. You say that inventory valuation is not correct, and management says that inventory valuation is correct. Then there has to be a paragraph in the financial statement which says that inventory valuation has been done by this and this. However, there is a different opinion. And you have to draw the fact to that particular inventory valuation as well. If the management is not ready to any disclosure in the financial statement about any disagreement or the area on which the disagreement exists, and you are just highlighting that matter, then it's a very difficult situation. So there are two qualifications or two disagreement. One, the management is not making a disagreement at all in the financial statement, because see, when you will arise a disagreement, the matter has to be very, very significant, first of all. And if a matter is significant and management doesn't even disclose in the financial statement, that there is an omission of disclosures in the financial statement, and hence the same has to be done or has to be disclosed in the financial statement. Don't make a qualification without any reference to the financial statement. Then in that case, you should also evaluate whether the disclosures are appropriately made or not. Any question till now? I think I have parked a couple of questions based on the Okay, so there are a couple of questions. I will just try to take one by one. First, one question was how to determine factual reporting and judgmental reporting. See, judgmental means entire evidence. There is certain set of uncertainty available in the entire judgment, like going concern. Correct. Going concern, whether the company will evaluate in the next 1 year or not. There are all enough indicators, but still this is a judgment. Internal audit appropriateness. There is no quantitative criteria what is appropriateness. Then you are taking a judgment that yes, it is appropriate. Whether the frequency or the physical verification of inventory or PP is appropriate, that is a judgment, whether it should be done 1 month, 3 months, 5 months. What is factual? Whether statutory deposit dues has been paid on time or not. Correct. Whether there are any unpaid dues, then that should be disclosed. Whether there are any cash losses or not. Whether the term loan has been applied appropriately or not. So these are all judgment, factual and not judgmental. Hope that answer the questions. So auditors and CARO. Now coming to the content of the auditor's report. What is the composition? And now here we are finding the common error in the financial statement. Correct. What do we write in the auditor's report? Let me just flash back the auditor's report. Word file visible? Can anybody just say whether the word file is visible or not? Okay. So if you see this entire auditor's report, first is the opinion paragraph. What can be the common mistake in this opinion paragraph? This opinion paragraph define what is the financial statement. Now under Ind AS, the definition of the financial statement is large. It includes also in P&L, it includes other comprehensive income and also the statement of changes in equity. Whereas under the normal accounting standard, you will have balance sheet, profit and loss, and cash flow statement. Whereas in case of Ind AS financial statement, it is balance sheet, profit and loss, including other comprehensive income, and cash flow statement and statement of changes in equity. So that is most important part that we should be very mindful. What is the composition of the financial statement for any one particular company? The second part is the year and the period. Year and the period means at times these are 15 months financial statement, 14 months financial statement. So if a company of the incorporation is less than 3 months, then the financial statement moves on to the next period and it becomes a financial statement for more than 12 months, but certainly less than 15 months. And therefore, it is to be, you can use the word year only if it is a year. Otherwise, it is to be used a period. If it is less than 12 months, it is to be a period. If it is more than 12 months, it has also to be a period. Third one is the results. At here we have to write that It represents the true and fair view of the state of the affairs of the company and the profit and loss. So at times we inadvertently we write profit, but if you see the financial statement, it will be loss. And then at times you write loss, otherwise it will be profit. Then other information. If I go downward, this entire qualified basis for our opinion is more or less same, correct? Then if the EOM comes into picture, CAM. What is key audit matter? Key audit matter is where you have thought of judgments, and those judgments, what audit procedures you do. So when you classify something as a key audit matter, you have to report in this way: key audit matters and how the matters are addressed by the auditors, what kind of procedures we done. There was a guidance note on how do we draft the key audit matters as well, and what kind of procedure we should write, we should not write. All of these were clearly stated. The third paragraph is other information. This has come in almost last 3 to 4 years. This is very, very important. Again, an onerous requirement from the government on the auditors. What it says that if the financial statement are becoming part of the annual report, a document, and there are other financial disclosures in that annual report, like a director's report. So whether the information which is being stated in the director's report is consistent with the financial statement. For example, if the director's report state that the turnover of the company has increased from so and so or from so and so, whether the turnover is being reported right or not, correct? That is one part. The second part is whether it would like be whether the, and yes, at times it happens that when the financials are signed, the director's report are not ready, and it is being ready and adopted by the company in the next meeting before it goes to the AGM. Then you have to write that nothing has been provided to you for review of the other information. So you have to be very, very mindful whether you got the director's report or you didn't got the director's report. Where if you got the director's report, whether you are able to verify it, and what it says that we have nothing to report in this regard. That means this paragraph explains your responsibility. Your responsibility is to ensure, is there any factual inconsistency? Mind you, the word is factual inconsistency. Factual inconsistency means something which you can verify factually, like what is the turnover of the case. But in case if it says that the company has saved or done a production of so many number of units, then you are not supposed to verify that. Correct. So you are only supposed to verify financial information and nothing else. If it says that the number of people or number of the employees are so much, then you are not supposed to verify that. What are you supposed to verify? Something which you have seen as a part of your audit, and now you are commenting on the other information appropriateness. Responsibilities of those charged with governance. This is very, very important. There is a change in the current year. It has said that who is those charged with governance? Any thought process? Who is those charged with governance? Those charged with governance are those people who are responsible for managing the day-to-day operations of the company. In case of company, it can be board of directors or the audit committees, or in case of LLP, it can be anything. And hence, we used to earlier write the board of directors are responsible for overseeing the financial insight. Now what the company has says, what the standard on auditing has says that if the management and those charged with governance are different, then you should write the word those charged with governance are responsibilities. Those charged with governance can be board of directors, can be audit committee as well. Auditors report on the financial statement, nothing significant to be reported here. Now, this is another important part in case of other matters. What is other matters? Other matters are those matters, as I rightly explained you, something which is not EOM and something which you have done. Where in case of, like in case of a standalone financial statement. Other matters can be financial statements which are not audited, a financial statement which are not audited by you, branch audit, any division audit, anything done by another firm of chartered accountant. These are all financial statement. These are all other matters. Or let's say the previous year financial statement are audited by another firm of chartered accountant. Then you will write something in the other matter. Next important part is report on other legal and regulatory requirement. Legal and regulatory requirement means this is another, I would say, onerous requirement by the MCA on us. What it requires that there are a few specific questions which you need to answer. The first one is the reporting to the CARO report, which is attached as a separate state period. The second one is we have stored all the information and explanation which is due. So if you have a qualification in the auditor's report, that means you are disagreeing to some matter, then you have to qualify this paragraph as well. Except for the matter stated in the auditor's report, we have obtained all the information and explanation. Same thing, our opinion, the proper books of accounts are maintained or not. The third one is we have received all the accounts of the branch offices or not. The common mistake which is being done in case of books of accounts. Suppose I remember last year there was a requirement that the backups of the servers on which the company's ERP system is residing has to be made on a daily basis, and the server has to be located in India. If any one of this thing is not being done, then it is being stated as a non-compliance of a books of accounts. And therefore, it will come in clause B of this paragraph that the books of accounts are maintained except the servers are not located in India or the servers are not subject to daily backups. The third one, which has come in the current year, is the audit trail. What it says that the audit trail has to be maintained. What is audit trail? I think there are different set of webinars which has been audit trail. I will quickly turn around that. Audit trail is something where any ERP system which has a function of verifying an audit trail, where it means who has posted these entries, when did it was posted, and who has uploaded this system. The entire trail of the transaction is made available in the system. That is what it is called audit trail, number one. And number two, that the audit trail is being tempered or not. That also the company has to report, or the auditor has to report. The fourth one is whether the balance sheet and the profit and loss account or the statement of the word are in agreement with the books of accounts. This is very interesting. So the MC also writes that the balance sheet which we are signing. So first of all, if you see the chain of events, it initially says whether the books of accounts are maintained or not. Yes, books of account are maintained. Whether this balance sheet and whether this financial statement are as per the books of the accounts, that also you need to report. Clause E, very, very important. In our opinion and aforesaid information, whether the whether the financial statement comply with the accounting standard, one should be very, very mindful. The common mistake done here is that the reference to the accounting standards are not correct. If your company of your client is under AS, then it should be company's accounting standard rules 2014. If your client is under IND AS, then it should be company's Indian accounting standard rules 2015. Next clause, if you have any qualifications in the auditor's report, then you need to evaluate whether it has any adverse functioning on the company or not, or whether it affects the functioning of the company adversely or not. And therefore, this has to be reported on this side. Adequacy of ICFR, that is fine. I don't see any major challenges. Managerial operations, I think we discussed that the managerial operations, managerial remunerations, if there are any, has to be disclosed in the financial, in the auditor's report, whether that is in line with 197 or not. Next one, whether the pending litigations, whether the pending litigations are being adequately disclosed or not. Now, it's very difficult to determine what is pending litigation. Pending litigation is any contingent liability, any taxes, anything, whether it is appropriately disclosed in the financial statement or not. This has to be disclosed. Next one, company has made adequate provisions for long-term contracts. Are there any transfers which has been done to investors and protection fund or not? And lastly, this is very onerous requirement, funding transaction. Just a second, I got some. What it says that if the company has received money on somebody's behalf with an instruction to pass on to somebody, then it has to be reported. This is the most judgmental part of the entire audit report, I can tell you. Because, and money in the sense, in terms of investment or borrowings, any money received from anybody with the instructions, and instruction has not to be in written, but also it can be verbal, then it has to be reported in this clause. Similarly, if the company has made any money or has lent or made investment or lent any money under the it has lent any money which with the instruction to give it to anybody, then it should be disclosed. Can anybody emphasize any situation which will come into this? I can give you one live example. Suppose you made an investment in one of your subsidiaries with a request to acquire one set of plant and machinery. Then it will get, it may not get, then it will get impacted or reported because the investment is made with an objective to acquire the plant and machinery. Then it may come here. So the idea is to that your way of giving the money should be also lending in terms of advances or in terms of loans or investments, and the other person should also be instruction to make an investment or give a loan, lending the money or making investment. If both the criteria are met, then the reporting will come under this clause. Then finally, the fifth one is the final dividend has been paid or not. This is more of a factual. So if somebody was asking me what is judgmental, this is, I would say this one is pretty factual, but very difficult to establish. A lot of judgment goes into this. This is very simple. Final dividend has been made or not. Okay. And the last one is the audit trail. Audit trail means whether the company has maintained enough audit trail in the current year or not. And if there are any qualifications, audit trail is not maintained, then we need to report it here. So I'm going back to my PPT. CAM, we discussed that any paragraph which is available or not. I think my PPT is visible, correct? I think now the PPT is visible. So the idea is that in case of auditor's report, we discussed CAM, we discussed whether the components of the auditor's report are made appropriately or not. This is very, very important. And at times, certain components are not audited by any chartered accountant. They are completely unaudited. Then in that case, we really need to disclose that these are the unaudited accounts, and this has been relied plainly on the management. So sometimes, and this applies mainly in case of CFS, that the few of the subsidiaries which are very minimal in operations, their disclosures, they are not audited, and hence the idea is to, and hence the same has to be carved out. So carving out of the component audit has to be done. Legal and regulatory requirement, we discuss server not maintained in India. These are all the errors. So first of all, I show you the entire audit report, and now we are talking about the common errors. server not maintained in India, server not subject to daily backup, audit trail not maintained, reference to the rules has to be correct. We discussed that if it is AS, then it has to be Companies Accounting Standard Rules 2014. If it is Ind AS, it has to be Indian Accounting Standard Rules 2015. Qualifications, if any, has to be evaluated whether there is an adverse effect on the functioning of the company or not. Managerial remuneration has to be in line with the financial statement, and reporting under the 11G. Provision for foreseeable losses, if any, for long-term contracts, including derivatives, including IPF fund, transfer to any IPF fund, including any delay or not, whether funding transactions, which we discussed, that any kind of instructions with whether you have made an investment or lent money to the audit person, then that has to be disclosed here. And lastly, the audit trail. So this was all about the all common potential error in the main audit report. We'll come to the CARO, and the larger number of the mistakes are found in the CARO because the reporting requirement is more large. But I thought, let me just first of all take you through the main audit report. Any questions on this main audit report till now? I have got few questions. Somebody has asked the format of the audit report for standalone for MSE listed. There is no different format for SME or non-SME listed company. All the auditors report are same. What to the extent you can differentiate, if some of the clauses or reporting requirement are not applicable, you can just write that this clause is not applicable. But there is, for every company, the reporting format is same. I hope that answered. Can the auditor's report be signed overseas using digital signature? Yes, auditor's report can be signed anywhere using digital signature. Then one question, how does the primary engagement team define what is classified as an adverse for CARO? We will hold it. How do we decide what is factual and that I discussed? Very nice question from Amrunal, that whether the cloud-based server will be treated as a server in India or not. To me, I think I have not yet emphasized that situation. But see, even what is important in case of a cloud bed also, see, ultimately it is residing on some physical asset, correct, somewhere in the world. What is a cloud? Cloud is nothing but a common server where everybody gets a part of it. So we need to see it in detail before we actually conclude on this. I am getting one question that do we have the I would like the format of the auditor's report we discussed. So Munal, I will again check with this question and will park it I'll get back to you after this session. But to me, I have seen that people see the cloud-based server are more for when is the actual server being located, and basis which they are being responding. So you can just ping me your email ID. I will get back to you on this. Okay. So assuming there are no further questions on the main auditor's report, let us move to the CARO, which is very, very, I would say, important. So what is CARO? Generally, CARO has 7 or 10 views about fixed assets, inventories, loan repayment, internal control systems, cost record, statutory dues, fraud. Any specific questions? Any specific questions? You have the yes, I got one more question. Sorry, I'm taking the question a little bit in intervene because it makes the session more interactive. Can audit report be signed on a different date that of the financial statement? Ideally not, because the subsequent event consideration has to be the date on which the financial statements are approved and signed. So you as auditor are supposed to see the subsequent event till the date you sign, and the management is also obliged to take the subsequent event till the date they sign. So what if something goes wrong between the two dates? So this is completely not advisable. And can CFS and FSFS be signed on different dates? Yes, technically yes, CFS and SFS can be signed on the same date, provided the subsequent event after the SFS has been signed and the CFS is being signed is being taken care of. So answer to the first question, no. The second question is yes. Okay. Now coming back to the CARO. See, in case of CARO, these are various clauses we all of know. So we'll take what are the common mistakes in the CARO. First, PPE. What are the three parts of the CARO reporting? Whether the PPE has been physically verified of the note. The second one is whether there are agreements and title deeds which are in the name of the company or not. So generally, what people has write that no reporting even PPE exists. At times, what happens that the company has just purchased an asset in the current year, a new asset which has been purchased in the current year. So they state that the company doesn't have any PPE, but actually there was a PPE. Secondly, the title deed does not include lease agreement. Whenever we are supposed to report whether the title deed on the immovable assets are in the name of the company or not, it also includes all the lease agreement in the name of the company. This is the most common error. People don't think that the lease agreements are supposed to be reported. So, but all the lease agreement has to be in the name of the company. And thirdly, if there are any exceptions, where the exceptions will arise, suppose a company has amalgamated another company and the assets are still in the name of the previous company, then you need to report in this clause that the assets are owned by the company, but they are not either in the name of the company because of the transfer of the ownership, because of merger or for any other reason. So these are the common errors which we did. Okay. Second one is inventory. Inventory, the reporting requirement is physical verification of the fixed assets. Physical verification of the inventory. Mind you, the reporting is that whether the inventory is being verified by the management or not. Same thing is in case of property, plant, and equipment. We are not supposed to state whether we did the physical verification or not. The obligation is whether the management is doing the physical verification or not, and whether that physical verification process is appropriate or not. That is what we are need to report. So please make sure you differentiate between the two, whether the inventory is being physically verified by the company or not. First of all, okay, reporting has to be done even if the inventory is held during the year, not at the year end. Suppose there was an inventory for the part of the year and not at the year end, then you also need to do that the company has inventory for the part of year and whether it was physically verified or not. Third and the foremost part is that whether there is a reporting requirement of the 10% threshold criteria. That 10% of the threshold criteria has to be done on a class by class basis. Means raw material different, finished goods different, trading goods different, and packing material of the stores different. If those are stored, those are being stated as a different line items in the financial statement. So you cannot club all of them together and say that overall the difference is less than 10%. You need to do it separately. And the fourth one is the working capital limits. Now, this is very interesting. Till last to last year, what used to happen that management used to disclose different financial parameters to the banks for the purpose of obtaining working capital limit and under the current assets. They might say a trade receivable is X, inventory is Y. So then they came out with a very unique requirement that no, the auditor will verify whether the inventory which is reported as X on a particular date in a year, whether it was actually X or it was X minus 1 or X plus 1. So again, this is a very onerous requirement because we are not supposed to audit financial statement on every quarter or month, and our responsibility is to audit the financial statement on every year end. But still we are obliged to report whether during the year whatever management has reported to the banks as a part of the working capital limits which has been obtained on hypothecation of the capital assets, sorry, current assets, then it has to be reported here. So I have one question, whether the PPE lying in CWIP needs to be reported. Yes, PPE lying in CWIP is nothing but a PPE only. It is just the CWIP and the PPE is whether it is put to use or it is not put to use. But a PPE is a PPE. Okay. Any questions on PPE and inventory? So these are the most common, these are the areas where there are most common mistakes which takes place. Now, even there is one or two more requirement, whether the company has done a physical revaluation of the assets or not, and we need to report whether revaluation. So my only question that suppose if a company is doing impairment or reversal of the impairment, is it a revaluation? No, it is not a revaluation. Revaluation means you appoint a revaluer, you determine a new value, and the revaluation of the inventory is being done or not, that has to be reported. Okay. Third and the most onerous requirement and most extensive requirement is loans, guarantees, and investment. What it says that if the guarantees has been given, investment has been made, or loans are given to anybody, most important part to anyone. It is LLP, any company, then you accept individuals. So it is, this reporting is not restricted to related party only. This reporting is applicable to any party to whom the loan is given. So be mindful of them. Then it says that there are few reporting requirements which has to be done. What are the reporting requirements? Whether the terms of the loans and whether the terms and conditions of the loans are prejudicial to the interest of the company or not. How do we determine prejudicial to the interest? If the company is borrowing money at 8% and they're lending below 8%, then obviously it is not prejudicial. That is prejudicial to the interest of the company. Whether the terms are very, very extensive, suppose if the company agrees to a particular loan for 5 years, then who knows the visibility of the 5 years? So there has to be business rationale for giving loan of 5 years with a fixed rate of interest. Third one is another, whether the repayment of the loan has been regular or not. So how do we do that? We see the loan agreement, we verify it, and then we see whether it is regular or not. If suppose you have if suppose you have extended the loan, means it was due to be repaid in the current year and you extended it, or you took the money back and you again gave a new loan, so it is called kind of cyclical transaction, then that has to be reported that a loan is never repaid, it is actually getting back and going back, getting back and going back. So they are just trying to understand whether the loans which are given or investments which are made or guarantee which are being made by the company are actually in the interest of the company or not, and if all those transactions exist, what are the terms and conditions and whether the terms and conditions are honored or not. The potential errors which can be made in all this set of the reporting requirements is even if there are any no balances at the year end, it has to be reported. Make sure compliance with 185 and 186, whether all the loans and the investment made are in compliance with the 185 and the 186 or not, that has to be disclosed. Okay. Terms and conditions are secured, unsecured, or prejudicial to the company's interest. Another common error is that whatever loans and advances which are being disclosed by the company in the financial statement doesn't align to the what is being disclosed by the auditors in the CARO report. So please make sure that all of them are aligned. But yes, the onus on the auditors is maximum, or it is higher because they have to disclose the maximum amount of the loan outstanding, which is nowhere disclosed in the financial statement. And lastly, again, I said that this has not to be seen with a loan with a related party only, but it has to be loan with everyone, anybody which has been given. So I've got a question. No guidance is available in reporting under clause 3, subclause 3A with respect to security given by entity. How should be complied with, as this is detail which is nowhere prepared or furnished by the company? Whether MCA change forms are sufficient to ensure. See, yes, security is, that's a very nice question. Security is more in form of that, whether if you have pledged your own investment in form of security for anybody's loan, or if you have placed your own assets. So in short, you are giving a guarantee, a kind of, you are supporting them through your own assets. You are not expressively giving a financial guarantee or a bank guarantee, but you are giving them, okay, fine, you take my shares, you take my assets for loan which is being taken by anybody else, or for guarantee which is taken by anybody else. I agree that there are no very precise guidances available for this part, but yes, the important part is that security has to be disclosed, and security is in the nature of some, if you have placed your own assets, I would take this as a security. Hope that answers the question. And the next question was whether MCA charge forms are sufficient. Yes, that is the best way to determine whether your own assets which are being placed for your own loans or for any guarantees or borrowings taken by any other companies, that is the best way to deal with this matter. The next one is the cost record. Cost record, verification of the cost record. Two common errors. At times people think that the cost audit and the cost, if somebody doesn't have a cost audit is not applicable, then the cost records are not applicable. No, cost audit is for a different set of companies with a different set of parameters, whereas cost records are with a different set of people and with set of different parameters. So cost record might be applicable to to few companies, whereas cost audit is applicable to a limited set of the companies. So make sure that the answer is whether the cost records are being maintained or not doesn't get completely replicated with what is being done for the cost audit. Another onerous requirement, repayment of loans. So now whether you give a loan to anybody, then entire disclosure comes in clause 3, subclause 3. If you take any loan, then the disclosures comes whether you have repaid the loan on a timely basis, whether you have defaulted for any loan, whether the term loan has been taken by the company but the auditor has not reported. What do you mean by term loan? Can anybody explain? How do you define term loan under CARO? A loan which is for a 6 months or a 1 year, fixed term of 6 months or a year is known as term loan. Any guess? Anybody can answer in the chat what is term loan? So in CARO, the term loan is defined as a loan which has a term of more than 3 years. So any loan which has a term of less than 3 years, fixed term of 6 months, 12 months, 24 months are not term loans. So don't make that error that any loan which has a fixed term has to be reported as a term loan. Next question comes, fund utilized for the purposes. Now, another common error which is being noticed in that how do you see the fund utilization? Fund utilized means short-term funds for the long-term purposes. I think I need, just give me 1 minute. I will just be back. So I was talking about the term loan. So term loan utilized for the funds used for the short-term purposes has been used for the long-term purposes. This is another area where many people make mistakes. This has to be generally there are two ways to look at it. This has to be seen on a balance sheet way. Balance sheet in the sense whether the current assets exceed current liabilities or not. If the current assets exceed current liability, that means the that means the long-term that means certain shareholder funds or long-term sources of funds has been used for short-term purposes. So ideally what happens is that the funds used for short-term purposes should not be used for long-term. That means you cannot have a loan from banks in cash credits or a short-term loan which has been used for long-term, means fixed assets or any non-current assets. So ideally your current liabilities should not exceed your current assets. Otherwise, there can be a negative reporting in CARO in this front. So this is one of the common area or one of the common error which may. And lastly, what happens at times, whenever there are exceptions to be reported, like in case of repayment of loans, default of loans, we need to give disclosures. Whether when the default was made, what was the amount, and whether it has been curated or remediated at the year end or not. All the 3 or 4 information is to be disclosed. Okay. Similarly, in case of a loan or borrowing, which are loan given, which are prejudicial to the interest of the company, then it has to be disclosed as, in this case, disclosures in case of loan or not reconciling to the. So here the reporting requirement that whatever reporting requirement under the CARO guidance note which is being given has to be disclosed very clearly. Otherwise, this can be an error or mistake. Okay. Fraud and whistleblower. Fraud and whistleblower means, now again this is a more of a judgmental requirement, whether there has been a fraud on the company or by the company. Now fraud on the company by the company is still easy to report, whether the company has done any fraud to the shareholder or not. But fraud on the company, any kind of small fraud which takes place, any kind of misappropriation of assets, duplicate booking of invoices with an intention to get or money from the company is all frauds. So this is a very extensive elaborative reporting requirement. And now the second reporting requirement which has come is consideration of the whistleblowers. Whistleblower complaint, whether the company has whistleblower mechanism or not, especially in case of a listed company, this is a mandatory requirement. If the annual report states that there are 5 whistleblower complaints, but if your CARO report states that there are no whistleblower complaint received during the year, then this is a form of inconsistency or error which can happen. Same in case of a repayment of loan, which I was discussing about. The financial statement says there was a default in the repayment of loan. Or let me put it otherwise. As per Schedule 3 also requires, if there is a default in the repayment of loan, it has to be stated in the financial statement. So auditor is writing in the in the auditor's report that there is a default in the repayment of loans, whereas the management is not writing that there is a default. So both of them has to be reconciled and make sure it is consistent. There cannot be any inconsistency in this. Secondly, related party transactions. Now, related party transactions, again, the kind of error here is that if the management has not disclosed all the related party transactions, which they are supposed to disclose related party transactions under the financial statement, the way it has to be disclosed, then this can be an error by the auditor. And hence, the auditor need to ensure whatever disclosures are supposed to be made as per IND AS 24, all of them are made clearly in the financial statements. And whether the section 187, 177 or 188 has been complied or not, this all has to be disclosed. Okay. Next, reporting internal audit report. Again, an important part. 2 reporting requirement, whether there is an internal audit which is in line with the size and comments, which is in accordance with the size and nature of the company. Again, a judgmental where you need to see whether the frequency of the auditor's report, internal report is high, whether they are taking the key areas or key appropriate risk areas or not. Like sales is the most important part in any company. If the internal auditor doesn't cover the sales in one financial year, that means the scope is not adequate. So the scope has to be seen in line with the business of the company. Like, for example, in case of a service or IT industry, the payroll cost is one of the most important cost. So therefore, that has to be covered as a part of internal audit scope, whether it is done appropriately or not. So hence, the frequency of the internal audit report is right or wrong, whether the scope of the internal audit is appropriate or not, that has to be very clearly discussed. So now what we do in many clients, the scope of the internal audit is being decided in consultation with the statutory audit. That is how the entire reporting is done, so that to avoid any particular negative reporting in the financial statement. I'm just going through the questions. Okay, fine, they're related. Secondly, if the internal audit report is there and they have disclosed or they have identified a lot of lapses, a lot of improvement areas, then you as an auditor need to evaluate its implication in ICFR. There were instances where noticed where internal audit report was qualified, the main report says the internal audit is not adequate. Then how do you give up a clean report on the ICFR? So the consistency between all the three reports has to be seen very clearly. Cash losses, determination of the cash losses, most important part. Then in CARO, the cash losses has to determine profit before tax plus depreciation. Mind you, many people does a common error of explaining the cash or determining the cash losses by adjusting the provisions or accruals. See, provisions and accruals are not meant to be adjusted. Only non-cash expenses or non-cash income has to be adjusted. What do you mean by non-cash expenses and non-cash income? Something which is like depreciation is a non-cash expenses or income, impairment of the assets is a non-cash assets or income. So all those things are non-cash assets or income which has to be treated. Provision or accrual are always treated as a cash expenses because it will be incurred in cash either today or tomorrow. It's just a matter of time which has to be seen. Going concern, support letter from management. The last one is the going concern, whether the support letter of the management is being, if at times the company receives the support letter from the management that in case of any need, any contingent liability or any kind of cases where liabilities will exceed assets, the holding company will support. And therefore, this has to be stated as a it has to be reported in the CARO that based on the support letter from the company, from the holding company, the going concern of the company has to be evaluated. At times, in case of many times, company doesn't. What I would say, the auditor concludes that there is a material certainty and uncertainty about going concern, but the same is not properly disclosed in the CARO. So then this is a kind of inconsistency between the CARO and the management disclosure. Any questions till now these topics? I think I've got a lot of questions. I'll take one by one on this front. Before that, I just move on to the. So let me take few questions first. So audit report format, I think I will share with the WARC faculty coordinator, and they will share with everybody. Now the cloud-based is pending. Why revenue recognition is considered as a CAM in many reports? Reason being, revenue recognition is an area which is considered to be most judgmental or which is subjected to management apprehension, because management may due to any incentive can suppress the revenue recognition. and hence that is to be considered as a CAM, key audit matter. Most important part and second part, every company which is being evaluated, we always see what is the revenue growth of the company, what is the top line of that company. So this number is very, very important from a market perspective. And the chances of fraud is suspected to be highest in this number, because the moment you change or inflate the revenue, your entire P&L and everything gets inflated. That may not be the case with any other line item in the balance sheet or P&L, and hence revenue is considered to be the case. Revenue may not be considered as CAM if there is no judgment involved. But in today's scenario, under the IND AS 115, it is very difficult to presume that there is no judgment involved in CAM. To what extent the revenue has to be recognized, whether the cutoff adjustments are made properly or not, whether the transactions price are appropriately determined or not, whether all the discounts which is being given to the customer dealers are being accounted or not. So there is many judgments which is involved in the revenue, and hence the revenue is considered as CAM. Can audited limited review and audit report? Yes, for year-end, audited limited review report and audited report has to be of the same date, unless and until the management believes that since it is a limit, since the last quarter is audited, so limited review and the main report will always be issued on the same date. And since these are two different reports, so obviously the UDIN will be two different. One next question for section on information other than financial statement. There are sometimes when other information, management analysis, board report, including business responsibility, is not ready on the date of signing of auditor, sometimes not even in their draft stages. Is there any guidance related to them? In that case, if that is not ready, so there are two questions, whether that is ready or not ready. If it is not ready, when it is going to be ready? It means which board meeting the management is going to approve. If it is going to be approved in the same meeting with a backdated concept, then you are in a very different challenge. So if it is to be approved in a next board meeting, then you can write that yes, the information is not available on the date of the signing of the report, and hence you have not reported anything. Whether primary auditor has to comment on all the items of Rule 11G on a consolidated level, say if dividends are declared by one of the components, whether the primary auditor need to capture the fact on their compliance in or consolidated financial statement. The primary auditor is responsible to give a consolidated reply for all the reporting requirements. But as far as dividend is considered, there, I think if subsidiary is declaring dividend, it will come to the holding company. So it may not impact to the stakeholders or the shareholders of the last company. So that may be skipped. But if the audit trail is there, and I would say, what do you say? In case of a contingent liability, which is disclosed on a contingent, on a consolidated basis in a consolidated financial statement. So every other clause has to be seen on a consolidated basis. For dividend, I think this has to be seen from the holding company only. Are we supposed to report grant received from government in CARO? If yes, under which clause? I don't emphasize with these limited facts that the grant received from government in CARO has to be reported. If you can give me more elaborative facts, then I will be able to answer it more appropriately. Is there any alternative to whether any proceedings are going to under prohibition of Benami property? No, Benami property, to the best of, is more of a management representation. In case where the loans and guarantees and securities exceeded the net worth of the company, should this be evaluated from the angle of prejudicial to the interest of company? It all depends what are the sources of the funds. So suppose if your asset size, you have given loans, you have given guarantees, and that exceeds the net worth, that means there will be some liability sides on that. Then you need to see whether you are a financing company which is borrowing money from one hand and giving money to the other hand, or whether the money has been given to the group companies or to the subsidiaries companies for their expansion. So it all depends on the purpose for which the guarantees and the loans has been given. If you are a holding company and you are giving guarantee, borrowing, and loan to your subsidiary company only, then certainly it is a more of a less worry situation. But if it is giving to the third party, and especially you are not in the business of providing finances, then it is a much more worrying situation. So it all depends on the facts of the case. But yes, your point is right. If the loans, guarantees, and everything exceeds the net worth of the company, then yes, that has to be a worrisome, and it is to be evaluated from the prejudicial perspective as well. But prejudicial is that again, it depends on the purpose and the tenure and other conditions, not only these amounts. Is whistleblower complaint even to a component of a listed company compulsorily? Yes, there is no exemption to whistleblower complaints for any particular set of company. Every company is supposed to, so what it requires that a listed company has to set a mechanism for receiving whistleblower complaints. Now, if in its whistleblower complaint they've received a whistleblower complaint for a component, then yes, the reporting will come. Otherwise, it will not come. Illustration provided in guidance note covers sometimes result in reporting of percentages of loan granted during the year at exceeding 100% since both renewal funds are not to be considered in numerator. Is there any further guidance on this? No. Even I have a situation where the loan was given, let's say 10 lakh rupees in previous year. The loan which is given in the current year 10 lakh rupees, and further it is extended by 20 lakh rupees. So the percentage will certainly be beyond 100%. There is no further guidance, and this is a very unique situation, but that's what the way it is. Is provision for liabilities written back needs to be adjusted by calculating cash losses? To me, it should not. The write backs and the bad debts there are different practices that the write backs and the bad debts are considered as a provision, as I would say non-cash items. But to me, it is more of a cash items, because ultimately when you bought the goods, you have received some materials, and now you are not paying for those materials and writing back the liabilities, and that's why it is to me it is a cash items. But I agree there are different practices on this front. If the nature of the company is to provide loan, then do we need to report in CARO? There are certain exemptions, certain category of the financial companies to which the CARO reporting is not applicable. We need to check on a case to case basis. To elaborate a little, a company has received grant from the government, set up the scheme. The grant will be received in 3 months, each in 23 for. I don't see any reason why should a government grant be disclosed in CARO. You need to tell me which clause you are anticipating whether the grant will be disclosed or not. I don't see any clauses under which government grants are has to be disclosed. So now coming to the another main observations, that if there are any errors in the financial statement, then auditor has to qualify the financial statement. So this was one of the common error which was noted by the QRB in its past. Non-compliance with the CARO requirement, these are more of a consequential impact on the CARO if you do some kind of non-compliance, but more of an informative in nature, which I can skip. See, most important part is how do we deal with all these problems? Number one, most important part is that do your auditor enhancement in training and education. Enhance your team, because you as a partner, signing partner on the job may not be able to verify 100% transaction. It is somebody under you who has seen it. So they should be very well aware. Auditors training and education has to be done for each and every report on the CARO. What we do in our office, that we give 2 clauses to one of our interns or fresh qualified chartered accountant. They do the research and present it to all the people. That is basically develop them as well, make them confident to speak, and enhance their technical and analytical skills, as well as it will share knowledge among the team. Internal controls follow the checklist which are being implemented by ICI for all these reportings. Please make sure that you follow checklist. There is a very high chance that if you don't follow the checklist, you may miss anything in the future. Transparency and compliance is there. So one last question which I have missed is that how does the primary team, so in consolidated financial statement, there is a reporting requirement that any adverse comment by the auditor of the component auditor CARO has to be disclosed. Now, what is adverse comment? Is cash loss an adverse comment? To me, it is not. Cash loss is not an adverse comment. It is more of a factual comment. What is adverse comment? Non-compliance of any default in the what do you say? Default in the loans repayment, not timely recovery of the loans, something which is adverse to the interest of the company has to be seen, which is being reported by the component auditor in the CARO report. I again emphasize that when you decide whether what is adverse or what is not adverse, something which is adverse to the functioning of the company has to be seen. Now, cash losses, it might not be adverse to the functioning if the company is in initial stages, there are losses on account of certain startup expenses, administrative expenses. But if the company is incurring losses for years and years and years, then it can be treated as an adverse. So again, this is a very judgmental requirement, which is being, I would say, which is being followed by different companies in a very, very different practices. But the whole idea is a reporting which is adverse to the functioning of the company has to be treated as such, and a reporting which is more of a facts in the nature has to be reported as such. I think with the given time frame, I have covered most of the key parts of the common error. I have more discussed about what is required to be disclosed rather than what mistakes can be made, because once you are aware that what is required to be disclosed, the chances of any error being made is little less, and whatever errors which whatever databases and information which was available in the public domain by ICI, I have covered all of them. But still two queries which I need to revert. One is a cloud-based server and one is the auditor's report format, which I will share with all of you. In case of any further questions, you can ask, or otherwise I am about to close the session almost on time. And sorry if I was running little fast or running little slow, but at times it is a little bit difficult to speak in front of a computer and with the audience is almost behind the wall. But with the set of questions which I'm getting and which I responded, I'm sure all of, I think 35 to 40% of people have asked the questions on an ongoing basis, which really makes easier for all of us to ensure that the participation is there. Still, if you have any questions, you note my email ID. This is my email ID, shreyans.ravrani@srb.in. You can drop me a mail any moment of time, and I'll try to respond as early as possible. Last question. In CFS, it's mandatory to give CARO. No, in CFS, you don't need to give CARO. You just need to give the report wherein if there are any adverse comment in any of the report of the holding company or the subsidiary company, that has to be given CARO. Otherwise, there is no requirement to give CARO in the CFS. With that, I over my session. And is there anybody, Chandan or Chintan Bhai, anybody present? Just a second. Yes, Chandan is here.
Yeah.
Yes, sir. I am done. I am not sure how good or bad it went, but yes, I could see a lot of participation, and I got more than 25 to 30 questions, which most of them have responded. There are two questions which we need to respond. One is whether the cloud-based server are considered to be server located in India or not, and we need to share with a common format of the auditor's report, which I will share with you, and you can share to the larger group.
Yes. So what is that question, Shreyans? The other one?
The other one was that if somebody has their ERP system on cloud-based server,
Okay.
so whether it is being stated as a server located in India.
So practically, in that case, the approach which was taken, okay, the cloud-based server are situated in either of the country. So in few clients, the cloud-based, the ERP provider had given a confirmation from the service provider that those servers are kept in somewhere in India with the name of the city. That confirmation was taken from the, for example, Oracle. That case was an Oracle case. where Oracle gave a confirmation to the company and the auditors that XYZ server, which is a cloud-based server, but the cloud situation was in Hyderabad, and that practical documentation was done, and appropriately it was done. So as an auditor, we need to go a step ahead to take that details. That was in 2 to 3 scenarios where further details were taken and appropriate details were provided. In addition to that, now in the financial statement, as we need to give the details of the server, etc., which started from last year in most accounts as part of the Companies Act changes. So there, all those details were also provided. Just an added thing over and above whatever Shreyans has to. So that was a question type, Shreyans, or
By one of the attendee, it was anonymous in the Q&A in the Q&A section. This question came.
okay, fine. That's fine. So overall, yes.
Overall, I think yes, and we need to share the report, or maybe I will share some guidance by institute where all the format of the auditor's report is being given.
So this presentation will be hosted on the WRC website. Anyone can go and take the presentation from WRC website. That's a part and parcel of the series. And I think so, first of all, thanks to Shreyans to taking out time out of his busy schedule and taking ahead on this topic. And I think so, for him, it's a bread and butter on CARO and audit report, because time and again he has reviewed several multiple audit report. CARO practically has dealt with a lot of topics. So I think so definitely to all the participants, they might have learned a lot practical. If you have any questions, you can reach out to Shreyans on his LinkedIn, or either to me. We can help you if any further queries are there. And definitely from WRC, we are really thankful for Shreyans for sparing the time.
Thank you very much. And I think my email ID, or if you may find me, I just enter shreyans.ravrani@srb.in. Whenever if you have any questions or anything, you can, or anybody of you can just ping or discuss. Not an issue.
Okay. Thank you. We can
thank you, everybody.
Yeah, we can stop the recording.
Yeah.
Thanks, Shreyans.
Thank you. Shalom. Bye-bye.
Thank you, Shreyans bhai. Thank you so much for your valuable insight in on this.
Thank you, Suresh ji. Thank you.